The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning, happy Friday, and welcome to Squawk Box Europe. I'm Juliana Tattlebaum here with Carolyn Roth, and these are your headlines this morning. A tense exchange as President Trump claims costs for renovations at the Federal Reserve have gone up on a visit to the site. But Fed Chair Jerome Powell fact-checks the U.S. leader.
You're including the Martin renovation. You just added our entire capital. Yeah, you just added in a third building. Is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's not new.
Sales at French luxury titan LVMH fall more than expected in the second quarter as CEO Bernard Arnault announces plans to open a second factory in Texas. Tariffs take their toll on German car giant VW. The group slashes its full-year outlook after operating profit plunges almost 30% in the second quarter. We hear from the CEO later on this morning. Good morning, everyone. TGIF. I mean, what a week. It's been so many earnings, so much happening on the macro front. We had the Japan-U.S. deal. We're waiting anxiously with bated breath for the European deal with the U.S. Could be a blueprint of what the Japanese have given us. And then this, what a top story on a Friday. It is a typical Friday story, though a very serious one if you look past all the building renovations and the cost overruns, right?
It is a very serious story. It's also a clip. You got a glimpse of it in the headlines that you just can't pull yourself away from. So I think we should get viewers right to it.
All right, President Donald Trump and Fed Chair Jerome Powell tussled over the cost of the ongoing renovations at the Federal Reserve during a visit on Thursday. The Fed Chair led the U.S. leader around the building works at the home of the FOMC. The meeting comes as the president has applied unprecedented pressure on the central bank to lower rates, as well as questioning Powell's suitability to complete his tenure as Fed chair. Towards the end of the visit, Trump and Powell spoke to reporters where they disagreed over the cost of the building works.
So we're taking a look, and it looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out.
Arnault said it about 3.1 as well.
3.1,
3.2.
This came from us?
Yes. I don't know who does that.
You're including the Martin renovation. You just added our entire capital. Yeah, you just added in a third building. Is what that is. That's a third building.
Well, no,
the
but it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But
it's
not new.
So we're going to take a look. We're going to see what's happening, and it's got a long way. Do you expect any more additional cost overruns?
Don't expect them. We're ready for them, but we have a little bit of a reserve that we may use, but no, we don't. Expect to be finished in 2027. We're well along, as you can see.
Now, Trump also spoke to reporters on his way out, where he said he did not think it would be necessary to fire Jerome Powell, adding, "I believe he's going to do the right thing." It's very difficult to look past the commentary and the tussle between the two. Again, the comedy value is priceless. The rooftop garden terraces, apparently they're not going through. I think they took away the rooftop seating, even though that was relatively inexpensive. But the irony won't be lost on anyone, given that Powell has also said that tariffs are leading to the cost overruns. That wasn't included in that exchange, unfortunately. That would have been nice.
There's so much we can say about this, and I wish we had more time. We have so many earnings to get to. But first of all, the fact that the exchange happened with both of them wearing hard hats. I mean, this is the entertainment value is surreal here. More seriously, The Fed, I think, was pretty shrewd because before President Trump's visit to the site, they actually invited reporters around for a tour. Politico writing up yesterday that they were invited for a tour of the building to help explain the cost to reporters. And the Fed cited new security features, the historic nature of the building as a couple of the reasons for the price tag. But to your point, as well as tariffs, preservation regulations, and building codes, but tariffs playing into the overrun here when it comes to the cost. One thing I would also add when it comes to President Trump, who is he playing at here? What is he trying to get at? You can say simply he's trying to put pressure on Powell to lower interest rates, and this is just another angle that he's coming at him on. Is he trying to put on a show for his base, which is all about standing up to the elite, the world's elite, holding them to account? Is he trying to create a scapegoat if the tariffs do lead to a negative economic impact on the U.S. economy? And then the last thing here, is he simply setting expectations for Powell's successor?
Very valid points, probably all of the above. I do wonder to what extent investors will continue to be rattled by this as they have been last week, understandably so, because the independence of the central bank is paramount, of course, but will they become more immune to this over the next couple of months as Trump has repeatedly said he's not going to fire him? So is this something that is sort of pushed to the side and we just get used to these constant attacks, which in itself is a very, very serious matter.
Yeah,
becoming used to that.
It's a great point. Well, we will pick up the conversation around the Fed later in the show, but let's get to NatWest results now. They're just crossing the wires, and Ritika joins us with the numbers. Ritika.
Yeah, well, NatWest put up another solid quarter and beat on both the top and bottom line estimates. They saw growth across all three of their major businesses when it comes to customer numbers, lending and deposits. If I run you through some of those numbers, so the second quarter revenues beat expectations, coming in at £4 billion, pre-tax profit up to £1.8 billion. And for the first half, pre-tax profit coming in at £3.6 billion. That's up some 18% from a year ago. Net interest margins, of course, a key profitability indicator, rose to 2.28%. They also announced some new announcements when it came to buybacks, up to £750 million. That's something investors would be watching. And mortgages, that actually rose to up £1.3 billion. That was something that maybe they expected a bit more subdued in the second quarter, given those stamp duty increases. I think also what was notable is that they upgraded their full year guidance to above 16 billion. So I'm pleased now to be joined by the CFO of NatWest, Katie Murray, to discuss these results in more detail. So Katie, thank you for joining us and congratulations on a strong set of results. Of course, we mentioned the beat on both the top and the bottom line. And what I thought that was interesting again is raising that full year guidance, because there do seem to be some dark clouds when we think about the economy. So what factors allowed you to do that, raising that guidance and also the share buybacks?
Sure, absolutely. Look, a great set of results, Rikita. It's great to be with you this morning. But when you look at it, income up, cost down, profits up, our returns 18.5%, and that's all driven by the work that we do with our customers and our clients across the country. And you can see there we also had loans were up, deposits were up, and AUM. So look, a really fantastic print. On all of those things together then take you to that actually we felt that this was a good time that we could raise guidance. So as you say, income up to over 16 billion and returns to up to 16.5%. So all competing to a really great return for our shareholders. And one of those bits of the returns is the share buyback of £750 million. And also importantly, a really strong increase in our dividend at 9.5 pence as well for the quarter. So overall, a great start to 2025.
A great start, but what is your outlook for the UK consumer going forward? Because yes, they've been resilient so far, but I think about challenges. The UK inflation has ticked up. There is uncertainty from ongoing tariffs. We have seen employment be a little weaker. Are you concerned about that at all?
No, obviously it's important to watch what's happening there. But when we look at our economics, one of the things we do every quarter is obviously step back and go, right, where are we in terms of our economic assumptions? And what's been really pleasing, actually, despite all the noise and all the things that are going on, they've moved a little bit, but really not materially. So the impact of that into our numbers has been quite low. If you look at our impairments charge, which is one of the key things for us that shows how healthy people are, you look at it and you go, well, it's 19 basis points. That seems quite high at first. And then you go, actually, of that 19, 8 of it's because of the acquisition you did with Sainsbury's. So the underlying is 11. Last year for the year, it was a 9 number. And that is a really historically low number for impairment. So we do obviously look closely, watch what's happening in unemployment and things like that. But actually, at the moment, the economics are kind of performing as we expect them to do at the beginning of the year, which is great given how much has gone on this year.
And banks are often said to be a barometer for the economy. So I ask you that if the economic data does begin to deteriorate significantly further, how well positioned are you for a potential credit downturn?
We're incredibly well positioned for that. We know that our customers are resilient. We can see the level of deposits that they have. We can also see, what happens if we move our assumptions about the kind of base case down to a more downside or an extreme downside, what that then does to our numbers. And while it's impactful, it's not so material in terms of the impacts of that. So we are well positioned for that. But I would say that's not something we're seeing in our numbers. It's not something we see in the day-to-day activity of how people are behaving, the lending that people are taking out, or the money that they're depositing, or the investments we're seeing into shares. So it's something we obviously work and we prepare for all the time, but it's not the reality that we think we're looking at the moment.
What about when it comes to mortgages? Obviously, they helped the results in this first half, but there was a lot of demand pulled forward because of those stamp duty hikes that came into effect in April. How strong do you think the mortgage market is going forward, particularly when we have seen house prices falling and increased supply?
Look, I think there's a couple of different things going on within there. I would say actually our Q2 numbers were a bit stronger than we expected because of that pull forward that you saw into Q1. We thought, of course, Q2 will be a little bit lower, but actually we were quite pleased with the print that we had, like 1.6 billion or 6.5 billion of gross new lending. So really kind of quite strong. At the moment, when you look at what the government is trying to do in terms of regulation to try to help in terms of the mortgage front, whether it be the kind of the levels of the stress that you have to put on people and things like that, or just how to kind of try to create some capacity within that market. So we do see there's a lot of demand at the moment there. It's a very active housing market, we feel, at the moment, more active than it had been in the last year. So it's good to see that. Then there's also a lot of competition between banks, so that's helpful for the consumer as well. It means that we have to work a bit harder to make sure that our NIM is going in the right direction.
And your results, of course, come off the back of what has been, the government's full exit from what a once struggling bank. So talk to me about, it's largely symbolic at this point, but it does raise a more meaningful question about where the bank goes from here. So can you talk about your growth strategy going forward?
Yeah, no, absolutely. It is symbolic, but they were a good shareholder and they really encouraged us and pushed us just to get on with the delivery of that. So what we've got is in terms of our strategy is, the growth, simplification and active balance sheet management. And where we are in terms of growth, we see there's a number of different areas across our balance sheet that we can grow. And you can see that in all of our lines, we've delivered that growth this quarter.
And in terms of, there's been a lot of speculation about M&A on the table. So did you bid for TSB?
No, obviously I won't comment on any particular transaction.
But acquisitions, they must be part of your growth strategy.
Absolutely.
Yes.
I have a large corporate development team who spend a lot of time, and you should assume that any transaction that's going on, we'll be having a look at to work out whether it fits with us strategically, it fits with us culturally, and then really importantly, it crosses some very strict financial hurdles. If you're invested in NatWest, you're assured of a greater than 15% return, in 2027. So anything that we're buying, it's got to fit in with those kind of metrics. But it is a high bar in terms of acquisition, but it's something we do. The Sainsbury's was obviously just completed in this quarter, and it's been a great acquisition for us.
What kind of businesses are you looking at potentially?
In terms of what we try to look at, is things that are going to either add capability or add volume. So if we look at where we are in the acquisitions we've done, we've clearly grown in the credit card space. We've done mortgage transactions, and that's the kind of space that we continue to look at.
And of course, you're very sensitive to the interest rate story, NatWest being very domestically focused. The Bank of England has cut interest rates from 5.25% to 4.25%, and they're expected to cut again. How is that impacting your net interest margins, and how do you hope to sustain those NIMs going forward?
So there's a couple of different things that you see going on in NIM at the moment. They've grown very nicely over the last little while, and given our income guidance, you should assume from that we'd expect NIM to continue to improve. And the reasons for that is largely due to the strength of our deposit base and the strength of our lending, but also through this thing that we call the structural hedge, which is where we take advantage of the rates and kind of lock in transactions as we go forward. And that's something that will deliver this year, $1 billion of additional income, and then next year over $1 billion of additional income onto our top line.
And very quickly, can I just ask you about how NatWest is planning to potentially use AI and new technologies to bring down that cost-income ratio?
Look, I mean, AI is something that's really important for us. We're using it a lot already. We've just signed partnerships with the likes of OpenAI and also with AWS and Accenture to really use AI in our data production. So we see it's something that we've given to all of our 60,000 staff to make sure they can be more productive and enhance the delivery that they have to help in terms of that simplification of the journey, and also ultimately one of the byproducts of that will be a benefit to the cost-income ratio.
All right, thank you so much, Katie.
Lovely, thanks, Ritika.
That was Katie Murray there, the NatWest CFO, joining to discuss all of the results and more. Back to you.
Thank you so much for breaking down the numbers and bringing us that fantastic interview. Coming up on the show, a hawkish hold. ECB President Christine Lagarde says the central bank will wait and see amid tariff uncertainty. Plus, not so luxurious. LVMH posts a 4% sales slide in the second quarter, but says it sees signs of improvement ahead. And we'll be joined by the U.S. representative to NATO, Matthew Whitaker, as geopolitical tensions remain in the spotlight.
U.S. and European negotiators are continuing talks over a trade deal as President Trump's August 1st deadline draws closer. Negotiators are currently looking at a 15% tariff on European imports into the U.S., according to reports similar to the deal struck with Japan earlier this week. Now, speaking to CNBC, Commerce Secretary Howard Lutnick stressed how keen the EU is on striking an agreement.
The EU really wants to make a deal. I mean, what's happened is Donald Trump sent them a letter and said, look, if we don't make a deal, you've got a huge trade deficit. I mean, $235 billion trade deficit, which means they sell us more stuff than we sell them. And so the president said it's 30% if you don't get a deal done. So you know how badly they want to make a deal.
Meantime, the ECB held rates for the first time in 8 meetings, as expected, with President Christine Lagarde saying the central bank will wait to see how risks to the outlook develop amid uncertainty over tariff levels, and that Eurozone growth has been in line with or slightly ahead of the ECB's projections. Traders pared back their bets on ECB easing later this year after the meeting. According to LSEG data, markets are now pricing a 50% chance of the central bank remaining on hold for the rest of the year and just a 15% chance of a cut in September. In response to a question from CNBC, Lagarde said the ECB has not adjusted its outlook in the wake of recent reporting on a potential US-EU trade deal.
We take things one day at a time. We decide meeting by meeting, but we take news one day at a time. And for the moment, we are relying on our baseline, relying on the scenario that we have done back in June, which we have published, which you all have had a chance to look at, and that's what it is. But one thing I will add to that is that the sooner this trade uncertainty is resolved, so I think we use the word resolved swiftly, so the sooner it is resolved, the less uncertainty we will have to deal with, and that would be welcome by any economic actors, including ourselves.
Yari Sten joins us now, Chief European Economist at Goldman Sachs. Yari, good morning to you.
Morning.
Great to have you with us. So one of your peers over at Citi published a note yesterday after the ECB meeting saying the press release of the Governing Council of the ECB was unusually short and devoid of message about the direction of the economy or monetary policy, and so was the press conference. Sounds like, from our brief discussion, that you would beg to differ, that we actually did learn a little bit about the direction of policy yesterday.
Yeah, I think so. I would agree with the first part in that the statement was not very informative. They kept rates as expected. They reiterated we're data dependent. But then we do think the press conference was more hawkish than expected. She noted that the economy is more resilient. She said that a resolution of the tariff dispute would be welcome. She also questioned whether tariffs would actually push down on inflation, as they had argued in June. And then, as we heard, they also said we are well positioned to wait and see what is happening in coming months. And so we do think that signals that they're comfortable with where rates currently are. Our interpretation is that if nothing happens, they hold, and you would really need to see a deterioration of the outlook for them to cut again. Now, of course, there's still uncertainties around trade, and we do expect the data to weaken in coming months, but there now isn't that much time between today and the 11th of September. And so we think it's more likely that they hold and that this is probably it. So we dropped our forecast for September cut. We now have them on hold at 2%.
So you actually did change your forecast on the back of yesterday's press conference.
We did, yes.
And in terms of the deterioration that the ECB would have to see to move ahead with another cut, flesh out for us what that deterioration would have to look like, even if it doesn't come by September, what the time frame is and how it would play out.
Sure, I would focus on three things. The first, most obvious, is trade. So we're all expecting there to be some form of deal, maybe around 15%, but we don't know that. And so I think the easiest route, if you like, for them to cut again would be for there to be much higher tariffs than anticipated. So we'll watch that. Second is that we do think the data will weaken in coming months. So there are signs of front loading around the tariff deadlines. The data has been better, as Lagarde said yesterday. So we do think it will weaken, but we don't think there will be a sharp weakening. But that's another issue, I think, to really look out for. And then the third is inflation. The news there have been relatively soft. The exchange rate is appreciating. We do think there'll be a little bit of an undershoot in inflation. But then President Lagarde yesterday also said they're not too concerned with a small undershoot. So I think it would only really matter if you had, a much bigger sign of an undershoot. So I would say the risks are still towards cuts rather than hikes. That's clear. But as I said, baseline for us is now that they're just sitting here at 2%.
Jari, let's stay with that point that you made on the exchange rate. Obviously, the ECB was asked about it yesterday, but they're never really concerned about the levels. They would probably not comment too much on that, also given the political environment that we're in. However, the pace of the increase, the pace of the appreciation has been so violent. Isn't that a cause for concern rather than the levels?
So I think it is about the change. I think that's true, and we have seen a notable appreciation. But I would say two things. One, it's not just the euro-dollar exchange rate that matters, but the trade-weighted exchange rate, and that has moved a lot less. And secondly, it's also important what is driving the appreciation. So in other words, if the euro is strengthening because investors are getting more confident about the outlook in Europe, given the German fiscal change and so on, then you're much less concerned about the euro strength than if it's happening due to something outside of the euro area. And so I would say so far we would say that it's probably both factors at play. The domestic improvement in the outlook might actually be the more important force. And so I think at the end of the day, yes, it is something that weighs on inflation. But for these reasons, we don't think it's at this stage a really big deal. And I think that was consistent with Lagarde's answer yesterday on this, which was quite boilerplate. We're monitoring this, but we're not targeting. So I think at this stage, it's a more minor factor in their thinking.
One of the major hawks, Mr. Holtzmann from the Austrian Central Bank, is stepping down very soon. How do you feel about the dynamics on the Governing Council in terms of the consensus that has been forming? So we're losing one hawk. Is it becoming more dovish overall?
I generally think these sort of personnel changes matter a little bit less than people think, because it's a big council. You have a range of views. You have a number of very good economists on the council. So I think the debate will be lively as ever. You have different views, different factions on the Governing Council. But I think it is true that over the last 2 to 3 months, there has been somewhat of a shift, as we heard yesterday, in really signaling that we're fine now to wait. And I do think the shifts in German fiscal policy that we've seen are an important part here, because we do think growth will pick up quite a lot next year. And it might not make a lot of sense to be cutting into that big growth pickup. So taking some time here, I think, makes sense.
When it comes to the trade impact, let's just go a little bit deeper there, given you said that's one of the three key pillars to watch in terms of data deterioration. There is some evidence that European exporters are beginning to absorb the cost of higher tariffs. Obviously, it's still early days. We're still waiting for an EU-US trade deal. But what is your early sense around how Europe is being impacted by the tariffs that are in place and by the threat of tariffs that still loom overhead?
Yeah, I mean, the growth effects so far have been much more limited than expected. So, many economists, including us, came into this thinking there's going to be a pretty quick negative effect, both from the tariffs themselves, but also from the uncertainty that's being created, because we still don't know where we will end up. But on the first point, the tariffs themselves so far actually have led to front loading rather than reductions in trade and production. Now, we are now seeing signs that this is reversing, so I would certainly expect this part to reverse, and we would then sort of have to average across Q1, Q2, Q3 to see the trend. But on the second point, the uncertainty point, I think this is where we are learning that it's less damaging than we thought, because the parts of the economy that we expected to be negatively affected by the uncertainty, so capital goods or confidence in Germany, have actually held up pretty well. So one possible explanation is that financial markets, financial conditions have taken all this quite favorably, whereas in past episodes of trade tensions, financial conditions have tightened a lot. So that might be the difference this time around.